Mark Eibel, manager of U.S. equity research at Russell Investments. They oversee $228 billion in assets. And in Houston, we're joined by Drew Kanaly, chairman of Kanaly Trust, which oversees nearly $2 billion in assets. Drew, let me start with you. Financials, a lot of write-downs. We've got some earnings coming up in the next week. Is it time to dip your toe back into those waters?
Nope, it's not time to dip your toes back into those waters yet. We still have a long way to go before the financial statements of our lending institutions stabilize.
You think that, Mark, the financial institutions are going to continue to report losses? They're going to weigh on their stocks? Are we going to continue to see write-downs that make it bad news for investors? Or is it just hard to get traction in that category now?
I think what we've seen in financials over the last 3 months, we will continue to see moving forward, and we're working our way through the process. And the volatility that we've seen in the markets, which has been tremendous, will continue. As you know, we're a manager of managers, and in our conversations with managers, we have been underweight in general the financial sector, but managers are selectively increasing that weight. But it is a very stock-by-stock basis, and a very still going to be an interesting, volatile part of the market to navigate, at least through the first half of this year.
Once we do see a bottom, Drew, would you go back into financials, or has the business model changed such that we're seeing fairly priced stocks right now?
Well, the business model really hasn't changed. What's going to change going forward is the amount of leverage people assume in the future. And maybe for a little while, the lending standards are going to increase. But you know, human nature, at some point, they're going to want to lend more money to the wrong people to try to keep their earnings going. So these cycles come and go. This one's just particularly acute because of the way all the loans got intertwined, whether it was CIVs or CDOs or whatever it was. Nobody was quite prepared for that. And then how all the institutions were kind of dependent upon each other kind of caught everybody off guard, especially the Federal Reserve. So it's going to be a while. We're learning some hard lessons here. And since we're not willing to take our medicine up front, it's going to take longer for this to turn around.
Financials, of course, make up the biggest weighting in the S&P 500, but a company that has the biggest weighting of almost any in the world is General Electric. Dismal results on Friday. Gentlemen, let me start with you, Mark. Are you concerned both for GE and for the broader markets if a company as diversified and as representative of the economy as they are can't meet estimates? As a matter of fact, misses them by a lot.
I think you put it well as far as representing the economy. If there is one stock that you can point to that represents the economy, it is GE. And when you look at the results that came out on Friday, of the 6 units, 4 of them were down. The finance and the money-related areas, of course, were down, and the infrastructure part of the company did fine. So I think what you see in GE is exactly what you're going to see as companies report. Finance companies are going to have a very difficult time, and companies in other areas of the market, such as infrastructure, are going to do well. So I think what's surprising in this case is just that there was really not as much of a warning in that from GE that the earnings were going to be down. So I think if they had said all along, look, the finance areas of our company is going to do difficult, the market wouldn't have reacted as negatively today. So I think the surprise factor and the fact that GE rarely has a negative surprise is what's more driving today's action, not that people are surprised that certain parts of their company had a difficult period.
Well, Drew, we're really getting into the heart of earnings season. Are you worried we'll see more surprises like that?
Yeah, Friday's news is going to be Monday's news. It's going to be Tuesday's news. You're going to see earnings revisions going throughout this cycle. We've had a backup in the economy. We still don't know that we've hit a recession, but we definitely are going to see a slowdown in earnings. So the revisions are going to keep coming through, and I think the GE experience on Friday is precisely what we're going to see going forward. GE is sort of an S&P 500 representative of the economy, and so you're going to see more and more of this going through the system.
Well, in 15 seconds before we go to the break here, would you stay out of stocks for the time being, Drew?
We're still overweight cash. We're still waiting to see if we won't retest the bottom. It seems like we can't get to 100% pessimism here, and we really need to retest those lows before we get optimistic again.
All right, that raises an interesting question. What do you do with your money? We need to take a short time out, but we'll find out what industries, what stocks, or what other assets our guests might like. More with Drew Kanaly of Kanaly Trust and Mark Eibel of Russell Investments after this break. We're back with our Market Week Roundtable. Rejoining us from Houston, Drew Kanaly, chairman of Kanaly Trust. And in Tacoma, Washington, we have Mark Eibel, manager of U.S. equity research at Russell Investments. Mark, Drew told us they're still overweight cash. What about you? Are you moving back into equities, or at this point still sitting on the sideline with a lot of money?
Well, we recommend for our clients, we're a manager of managers, as you know, and we recommend diversified portfolios. So we're not making a decision as far as when to be in the market or not. Our funds, our equity funds are always going to be in the market. So our managers don't make that decision. We let our clients make those types of asset allocation decisions. So in that case, we are in the market.
All right. What are you in the market at this point? What would you be overweight?
Our managers are still have more of a growth bias when you roll it up in our multi-manager funds, as they've had for over the last year. So overweighting areas such as technology, healthcare, underweighting financials, though as I mentioned, that gap seems to be narrowing a little bit, and selectively overweighting some of the materials areas and underweighting areas slightly related to the consumer.
Well, tell me about materials, because with GE's news, people might be afraid of that sector.
Yeah, and again, with the GE news, if you look at more of the infrastructure part of it, that part of their business did very well. So when I'm talking about materials, and it's in areas, if you want to talk about commodities related, agriculture related, names like Monsanto, names like DuPont that have raised guidance already for the year and have done quite well. Defense names have done well, and names that we've overweighted in our strategy as well. So it's really selective pockets that we believe, our managers believe, will benefit the global story, the global growth story, which might be slowing down a bit, but we think is still stronger than it is in the U.S.
Drew, Mark mentioned healthcare, classic defensive strategy. Since you're nervous about equities, are you looking at, in that space, healthcare stocks?
Yeah, we're looking at healthcare stocks, but with an eye on the election coming up. You know, any talk about changing the healthcare system, you never know which part of the healthcare system it's going to adversely affect. So we like healthcare in a defensive sense, but we're very cautious about it.
When you say the election, what specifically would you look to see what's going to affect the stock?
Well, what you're looking for is things that, you know, from a legislative sense, essentially nationalizing health care. Where are they going to try to extract savings from the existing health care system? So you're trying to look to see what areas of health care might be threatened by legislation going forward. But that's really more of an August concern. We still look to the health care right now for a nice defensive position for our stocks.
Well, where else are you looking besides health care?
Anything tied to a multinational strategy. I mean, we're still seeing enormous growth potential overseas in emerging markets and even very mature international markets. So whether it's a domestic stock here in the U.S. that's selling goods abroad, or a foreign company that's selling goods around the world, that's really where our theme begins. And from there, you know, we can go to things like technology, and we can look in other areas as well.
Well, Mark, you both mentioned technology. That's a very big category. What are you looking at within that space?
Names that our managers were very successful in last year are by and large the ones who are still overweight. So names like Research in Motion, names like an Apple, very good growth stories, very good product lines. Again, very strong performers last year, had a difficult time in the first quarter, and have really seen them come back in the March timeframe and in April timeframe. So it's areas, it's products and companies that will take advantage of that global growth story that Drew had mentioned as well, that we think have solid product lines and that our managers think are good growth stories. So it's in those types of names.
All right. Well, thank you very much, Mark Eibel of Russell Investments and Drew Kanaly of Kanaly Trust.